If you look at the markets from the July lows, we've been making a series of higher bottoms, and until we take out those bottoms, then there's really not a whole lot to worry about. Now, once we take out that rising trend of bottoms, now we got a different story to talk about.
Welcome to Wealthion. I'm Wealthion founder Adam Taggart, welcoming you back at the end of another week for a weekly market recap featuring my good friend Lance Roberts. How you doing, Lance?
Well, it's Friday. We made it.
We did make it, and it's kind of an interesting Friday. Interesting last day of the week. Market's down pretty hard. I think this is partially due, at least, to the $2.1 trillion options expiration that occurred today. But what's driving things?
Pretty much, look, the market's had a fantastic run, 9 weeks of an advance here. We've gone up 17% in 9 weeks. Pretty much an unabated rally. He's gotten everybody, 10 weeks ago, we were sitting here talking about how negative everybody was on the markets, and that you've got the extreme bearish sentiment. You've got very negative, investor positioning. Everybody, thinks the world's coming to an end. And, 9 weeks later now, everybody's as bullish as they can get. And so we have, one day where the market's down, 1.5%. And it's like, oh my gosh, is the bear market back? It's like, just take a breath here for a second and just realize we've had a very long run. The market is about 9% above the 50-day moving average in terms of a standard deviation. That's very stretched. And if you just take a look at, it's not now, but it was 2 standard deviations above the 50-day moving average. Again, just these technical measures that just all suggested the markets had gone a little bit too far, too fast. And you need a little bit of profit taking here. And of course, there's been some interesting headlines in the meme stock area and in cryptocurrencies as well. Those getting, taken to the woodshed a little bit today, but those have all been proxies for this kind of very speculative rally we've had over the last couple of weeks. And short covering in particular has been a major driver of that, with short covering really kind of reaching, some of the highest levels we've seen ever on record.
Okay. And when you say forced covering, you really mean shorts being forced to cover, right? As the price is getting pushed up by the bulls, people who are short are now taking losses that they don't want to take anymore, can't afford to take. So they're having to buy back the shares to cover their shorts. That buying is adding additional upward pressure on the stocks. And as we know, you mentioned sort of some of these meme stocks. GameStop was a great example of that last year, where some people with some huge short positions just got destroyed because they couldn't get out in time while the stock was sort of being pushed up to the moon in this big short squeeze.
Right.
Yeah. So we are seeing some interesting instances of that. And I actually want to ask you about the Bed Bath & Beyond one later on in this conversation, because there's sort of a rant attached to it. But as we look at the week's actions, today is obviously a down day, like you said. It looks like we're down for the week. Stocks are down slightly for the week. Bond yields are up for the week, meaning that bonds are down. A lot of commodities are getting hit fairly hard. Precious metals got hit pretty hard the past couple of days. Cryptos are getting just crushed today, like double-digit losses on a number of them. So I guess the question, which we don't know the answer to yet, is hey, is this just some froth coming out of the continued rally, and this is just sort of the pause that refreshes before it keeps on going higher, or is this a sign that the rally is late in the tooth and petering out? And I guess we don't know for sure yet, but what are the things you're going to look at to try to help assess that decision?
Well, look, right now, it is what it is. The market's in a bullish trend. We've triggered a lot of kind of bullish buy signals here. The number of stocks above their 50-day moving average, 50% retracement of the previous rally, all those type of things, right? So markets have broken above the 50-day moving average, got above the 100-day, tested and failed at the resistance level to 200-day moving average. So, you've got a lot of bullish backdrop here. So again, just because the markets are down one day, and this is the first good sell day that we've had really in about 8-9 weeks now, where there's actually, some kind of blood in the water. But again, it's just one day. If this thing, Monday morning, we reverse this whole thing and run up 2% on Monday, then, it is what it is. So, right now, the thing to be looking for from a positioning standpoint is if you thought you missed this rally, going up, then we've been talking about the markets are very overbought. You're going to get a pullback. You'll see this pullback to probably some level. 100-day moving average, the 50-day moving average, two good key entry points there to try to add some exposure to your portfolio if you want to. If you break the 50-day, we're clearly going to be back. Now once you break below the 50-day, now you're clearly back into the bear market trend. You're probably going to take out the lows, and everybody's going to point back and say, "See, that was just a bear market rally," and got all the bulls excited, and that can certainly be the case here. But as we've talked about before, trying to make predictions is the most difficult thing, right? So there's a lot of people that missed this rally on the way up, and now they're going, "See, I told you it was just a bear market rally, and now it's going to go down again." There's no way to know that. And likewise, the bulls, especially in the mainstream media, they're like, "Oh yeah, this is just buy the dip." Now we're back into buy the dip mode.
Yeah,
and they don't know if they're right either. So, only time will tell here. And, the thing we've got to be careful of is trying to predict what the market's going to do and just let it tell us what it needs to do.
Okay. So basically you're saying the light's still green, meaning we're still in the bullish uptrend, but you're going to be watching those daily moving averages really closely, and they'll be one of the important factors that sort of tells the tale as we go on here.
Yeah, okay. I mean, if you look at the markets from the July lows, we've been making a series of higher bottoms, and until we take out those bottoms, then there's really not a whole lot to worry about. Now, once we take out that rising trend of bottoms, now we got a different story to talk about.
Okay. All right. So let's switch from the technical to the fundamental for a second here. So we also had some big news this week, at least a big update. We had the Fed minutes from their monthly meeting. They didn't really change the script all that much. They basically said, look, inflation's, reducing inflation is still our number one goal here. They said they remain, quote, highly attentive to inflation risks and are committed to bringing down price increases, even if it slows economic growth. So they're basically telling us, to the extent that we want to believe them, that, hey, if we've got to, if we've got to slow the economy further and beat up on growth, sacrifice growth a bit to get inflation down, we're going to make that trade-off here, right? And that's pretty much what they've been saying. The one thing I want to say, what was sort of newish there that I think the markets interpreted bullishly, I'm not sure if they should have been interpreted as bullishly as they did, is the minutes showed that there was some officials saying that, quote, it likely will become appropriate at some point to slow the pace of policy rate increases because the Fed could tighten the stance of policy by more than necessary to restore price stability. So this is basically saying, some people are saying like, hey, we may overcorrect at some point, and so we may need to slow our rate hikes down to minimize that damage at some point. They're not saying they're going to slow it anytime soon. It's just sort of a trial balloon here, but the market sort of interpreted that as, oh, okay, that's a sign that they're going to put the brakes, or maybe pause, if not pivot at some point sooner, right? The big issue to me still remains what we've been talking about here, Lance, which is today aside, essentially, the markets have still been rallying hard. They've been rallying hard up until this Fed minutes meeting on Wednesday. And the jobs data that the Fed is looking at still looks white hot. So, unless today begins a trend and the market, has some sort of cardiac arrest from here, I think the Fed feels pretty emboldened to be able to keep hiking because it's not, quote unquote, breaking anything yet. And, as you and I have talked about, I think the Fed wants to get away with as many rate hikes as it can get away with so that it has room to cut things the next time things begin to seize up. What do you think?
Well, no, you're absolutely right. And it's interesting because, the one line that you stated there that the markets took bullishly was at some point the Fed will will slow their rate hikes. Well, no kidding. That's just basic logic.
Right.
They're gonna slow probably at this next meeting. They'll probably do 50 basis point hike at this next meeting, and then they might do 25 after that. Because they even noted the lag effect of monetary policy. Once they hike rates, it takes about 9 months. We've talked about that before for that to come back through the economy. So, they're going to take a measured approach at some point here, and yes, logically slow their pace of rate hikes until they can determine exactly how far they've gone. because what they're admitting to is the risk of a policy mistake, which they've always made. So apparently somebody looked at one of the charts I've been publishing lately, pointing to all their policy mistakes and said, maybe,
hey, maybe Lance is onto something here.
Yeah. And so we'll see what happens. I'm sure it wasn't my chart, but you know what I'm saying? But the point is they always make a policy mistake. And this goes all the way back to the 50s and the 60s. And it leads to either a bear market, a recession, or some type of financial crisis to some degree. And it's just a function of interest rates on economic growth. And yes, while employment is strong, as we've talked about before, that is very much a lagging indicator that is very subject to big revisions. PricewaterhouseCoopers just came out with a survey. It was on Yahoo Finance this morning, I believe. And just talking about how they surveyed all the companies that they do work for, right? And so they do their survey of all their companies, and 50% of the corporations that they surveyed said that they will be reducing headcount. So, so the unemployment rate is going to go up. And it's very interesting though, because if you take a look at financial conditions have actually improved. In other words, they've become more accommodative over the last couple of months because of this rally. And, so for the Fed, who's trying to tighten financial conditions in order to slow economic growth and quell inflation, the market is actually making financial conditions easier, which is also kind of frustrating the Fed here because they're trying to hike rates and tighten these conditions, but the market is both working for them and against them. It's where, as you noted, is working for them by giving them plenty of room. There's no financial instability. Credit spreads are completely fine here. There's no risk in high yield. So there's no financial instability that would require them to cut rates to zero and start doing another round of quantitative easing. At the same time, though, the rally in the markets and the drop in yields is making financial conditions easier, which is helping keep consumers going. And we just saw retail sales come in. Consumers are still able to kind of, move on to debt here, and that's going to help sustain inflation longer. So it's really kind of a double-edged sword for the Fed, and it'll be depending on how they deal with it.
All right. So I think one example of what you're talking about is mortgage rates have come down to like 5.1, 5.2, having been up near 6% a few months back. Right. Can you just sort of explain how that happens? In other words, the Fed's out there very busily hiking the Fed funds rate, right? Yeah. Just added 75 basis points at its last meeting. Market expects it to add 50 or 75 again. What sort of justifies a cool off in mortgage rates in that kind of aggressive Fed hiking environment?
Well, because you're looking at two different rates. I mean, we got to remember, we talked about this before, is that, there's a lot of people who say, well, the Fed's hiking rates, this means the 10-year treasury has to go to the moon. And that's absolutely not true.
Right.
In fact,
much more influence on the short end, right?
Yeah. I mean, the only place that the Fed has influence is on the short end. So the highest correlation is between the 1 and 3 month treasury bill and the Fed funds rate. There's a fairly high correlation out to 2 years. But once you start getting beyond that, there's actually becomes, like I said, with the 10-year treasury, it tends to drop in yield as the Fed is tightening monetary conditions because money starts shifting into risk off mode. And, investors start to look for places of safety where they can establish, cash positions while they're waiting for the bear market or whatever to happen. So, this is one of the mistakes that we make a lot is by trying to equate what the Fed's doing to the long end of the curve. And sometimes those don't have anything to do with each other, as you see here with the 30-year treasury mortgage rate.
Mortgage rates. Yeah, that's a great point. I guess it's just that the banks that are lending are getting more optimistic about the long run, which I guess maybe you might expect them to do that during a period where the markets have gone up 17% in 9 weeks. So I guess you did just answer my question. All right. So back to the point about the Fed in the policy mistake. I was talking to Stephanie Pomboy earlier this week, and I think you and I may also feel the same way. If you believe that the Fed tightening so hard that it creates a recession is a policy mistake, she thinks the policy mistake's already been made. Right. In other words, you and I talked last week about the rate of change, Lance, and how quickly the Fed has raised rates so far this year. And then there's that delay that you mentioned, right? And so, the danger that can happen from here is that we do slow into a recession the way that all the preponderance of data seems like we're heading in that trajectory. And let's say that arrives by the end of the year. Well, the Fed only started tightening starting in February of this year, right? We haven't even, they say that there's a, average around 9 month or so, delay in the Fed pulling a lever before you see the impact in the economy. So we still haven't technically, seen the full effect of those initial February cuts yet in the economy, right? And then we have a whole series of months after that, sort of stacked, that's still rolling in. So the danger is, as you fall into recession, then you have this rolling thunder of the impact of all the hikes that have been done in the recent past continuing to hit, right? I sort of think of it as like a multi-car pileup on the highway in the fog, right? Where you've got the accident, but cars driving in can't see it, and so they just slam into it. They just keep slamming into it, making worse, right? So I think there's a danger of that. Will it happen? Who knows? We'll be tracking it on this program. But again, I kind of go back to this disconnect between the optimism in the markets, in the disconnect with A, the story the Fed is telling, and B, all the fundamentals that you and I look at, right? And Stephanie used a term that I thought just sort of nailed it, where she said the markets were whistling past the graveyard right now. They just don't care what the data is saying right now, more or less. They're just happy and confident, and nothing can shake them out of that for the time being. Today might be a little bit of a crack in that facade, but who knows? But anyways, go for it.
Well, no, I look, again, take a look at the economic data as an example, right? We've seen, some of the manufacturing indexes turn back up here lately. We've seen the Citigroup Economic Surprise Index turn back positive. And this is something you and I talked about, I think, either last week or week before, is that, it's not going to be surprising that after 2 quarters of negative growth, that we don't see an uptick in some economic activity. It's just kind of how the economy works. You get this supply and demand kind of ebb and flow in the economy. Yeah. And so in the first couple of quarters, people were really retrenching here. So you get some pent up demand, and then they have to go back and do things. We talked about back to school, and we've got the holiday shopping season coming up. Halloween, second biggest shopping day of the year, believe it or not. Then you've got Thanksgiving, Christmas right behind it. So you've got some impetus here for better economic data. And this is why, it's, you have to be careful. There's a large contingent of people that are saying, oh, markets are whistling past the graveyard of what's going on. May be the case. The other side of the argument is maybe the markets are leading the economic data, which markets tend to do. They tend to be a leading economic indicator. And maybe they're starting to sniff out. Yeah. And maybe they're starting to sniff out that maybe we're at the bottom of kind of the economic trough here. Now, I'm not saying we are or we aren't. So don't go, don't everybody on watch and don't go make a bunch of comments here. I'm just laying out both cases. This is the risk that you take of picking that one-sided stance, one way or the other, being Jim Cramer, uber bullish, you need to be all in, or, the markets are, completely ignoring the reality of the data, and it's got a lot more to go. Now, we'll say this. There is something that the markets seem to be overlooking. The markets right now are exactly where they were in September of 2021. So here we are a year later, and we're at the same level we were price-wise. The difference is back in September of 2021, the Fed interest rates were 0, and we were doing $120 billion a month in QE.
Right.
Then now we've got Fed interest rates at 2.25, and you're doing $95 billion a month in quantitative tightening.
Right.
So
plus
you've
additional
got
rate hikes.
Plus additional rate hikes. So, but just quantitative tightening and rate hikes alone, you've got a very different environment that markets do seem to be ignoring. And again, the big difference here between now and then, and if you want to make a bullish case, this is really kind of the thorn in the side of the bullish case, is that you have monetary tightening going on, and markets don't tend to do well when the Fed is tightening monetary policy. Because why do they tighten monetary policy? Go back to square one. They do it to slow economic demand in order to quell inflation. Well, if they slow economic demand, that means that earnings have to come down because people are spending less. That means corporate profitability has to come down. Margins are going to come down. And that means that prices are still too high, because we're still trading at 30 times valuations after this rally on Cape valuation. So we're still at exceedingly high levels. And I'm writing an article right now about the rule of 20, which is where you take inflation plus valuations and add those two together. If you're over 20, that's extremely overvalued. And if you're below 20, that's extremely undervalued. So you buy when you're undervalued, sell when you're overvalued. Well, we're at the second highest level ever. The only peak higher than where we are right now on the rule of 20 is during the .com crash. Again, we forget, that there's these variables out there that certainly weigh against that bullish case.
All right. Well, look, to the extent that there are some bullish market indicators that are coming out here, I'm going to look to you to bring them up here, because a lot of the data I pulled that I'm about to dive into is more on the bearish side of things. It's just not intentional. It's just what I'm finding as I look through this.
No. Look, this was our conversation all week in our investment policy committee meetings. Our conversations all week were: here's the bull case, here's the bear case. They're evenly matched.
Okay, well, that's interesting.
So what do you do?
Yeah, we'll bring some of that up. And again, I don't want to diminish at all the challenge that you and your team have as capital allocators. As we always say every week, you have to trade the market we have, not the market you wish we had, right? So you can't get too philosophically attached to one side. You just have to look at what's happening on the ground and make your best assessment, right? So let me just throw a couple of things out there. Most of these are going to be, I would say, more concerning data. And if you've got, other things on the other side of the ledger to refute them, great. But the IMF recently came out with its revised projections for global growth. It had 6.1% for last year, 2021. It just revised downward 2022 to 3.2%. So almost a 50% cut in growth. Maybe not a huge surprise in the wake of all the trade disruptions and, the fact that the markets are down and all that stuff. But that's a big decline. And then they have next year, 2023, coming in even lower at 2.9%, right? So they're continuing to ratchet down their growth, and they're citing all the same things that you and I would: high inflation, China going into lockdown, the trade disruptions from the Ukraine war, all that type of stuff. Now, GDP Now, which we talk about from time to time, real-time estimator, they have a bunch of factors that they put in there, so it ping-pongs all around, as you always are wont to remind me. It jumped up pretty high 2 weeks back when that crazy jobs report came out that you and I don't know if we fully believed it, but it's the data that goes into the model, right? And it had been relatively low before that, but jumped way up after that data point came in. Well, it now just jumped back down again to 1.6%. So we still have a month and a half left. We'll see how this plays out, but it's already back, returning to kind of trending its way down again, like it has the past 2 quarters before it ended up finishing the quarters in the negative, right? Could it be positive? Sure, but it doesn't look like it's going to be a barn burner that's going to make up for the contraction that we saw in the first 2 quarters of the year, right?
And just remember also, when you take a look at the Atlanta Fed GDP, it's an annualized rate. So when they say it's 1%, let's just say they go, it's our rate is 1%. That means it's actually 0.25% for the quarter. So it's 0.25% growth for the quarter. Then they annualize it out for 4 quarters. So that's how they get the 1%. So it's not really 1%. It's really much less. And so, look, as we said before, I'm not going to be surprised if we see a slightly positive economic growth number in Q3, and maybe even see Q2 revised up to 0.1% growth, something like that.
All right, great, Lance. Hey, so just to get through some of this list, so we can get to a few other topics too. So, an important factor of what's going to drive economic growth from here, obviously, is incomes, right? And as you and I have talked about, if you're looking at the job market right now, irregardless of that really rosy payrolls number that just came out, a lot of other jobs related data that are out there are much less sanguine. And one of the things that we've been following over the past couple of months is the hiring freezes that have been creeping in, and the return of layoffs, and the layoffs kind of keep building momentum here. So I'm just going to run some stats by you real quick. One is, initial claims, the measurement of unemployment. Those have been ticking up. They bottomed back in March at about 160,000. They're now at 260,000. So that's a over 60% increase in just a couple of months. It's still at quite a low level, but still, it does look like the bottom is in for unemployment, and the trajectory is up, right? But then if you actually look at the rate of layoffs, which you and I have, they really are building a lot. I was just on an interview the other day, so I prepared this list for that, but let me just quickly run through it. Just today, Wayfair announced that they're laying off 5% of their staff, right? Wayfair is a online retailer. Peloton is letting go over 4,000 people. Shopify is letting go over 1,000. 7-Eleven, almost 1,000 management positions. Vimeo is laying off 6%. Tesla has already announced that they're going to be laying off 10% of their staff. Rivian, another competing car company, 6% of their staff. Ford is letting off 8,000 folks. Remax, a real estate firm, is laying off 17%. JP Morgan is laying off 1,000 in their home lending department. Wells Fargo is laying off folks, but they didn't disclose how much. Compass, another real estate firm, is laying off 10%. Redfin, another real estate, 6%. Coinbase laying off 18%. Carvana, 25,000 positions. Better.com, 5,000. Robinhood, 9%. Also, Netflix and PayPal have announced layoffs as well. They just haven't been specific in terms of numbers. But this is not relegated to just, okay, it's those few tech companies that were overvalued, or it's just the mortgage lenders or whatnot. This is beginning to become a pretty wide swath of relatively big players in the economy. And then on top of there's a bunch of players like Facebook and Google and Microsoft who have all announced hiring freezes and whatnot. So the layoffs train seems to be building up of steam here. And there's that layoff indicator that the chart that I look at, which shows that Q2 layoffs were back at the same magnitude as where they were back during the height of the shutdown of the economy during COVID. And Q3 layoffs this year are almost as big as Q2, but of course we're only halfway through Q3 at the moment here. So, on the job side of things are beginning to look like, layoffs of a substantial scope could be in the future.
Well, and again, what you hear about is just the big companies, right? The only things we hear about in the headlines, like all those you quoted, Peloton, and, interesting enough, Peloton's now changing their bikes. You just bought a Peloton, which is cool. And they had the tech come out and assemble it for you. Now they're going to redo the whole thing. So it's a DIY. Yeah. So great. Now I get a bike and I have to put it together myself. So, but that's to reduce labor, right? I don't have to have a delivery truck now. Yeah. I get rid of the person and, I can just ship it by FedEx and it shows up in, 5 million pieces like an IKEA couch and you're good to go. So, it's going to save them labor. But see, those are the ones you hear about. What you don't hear about are all the small to medium-sized businesses around the country that are laying off workers. And those don't make headlines because it's just, Joe, the guy in the back that's, loading up boxes, or, the construction worker that, reducing crew sizes or whatever. Those are those layoffs and jobs that you don't see. And, a lot of those people don't file jobless claims. Some of them do, but there's a lot of people that don't. They go out and they start looking for another job. So, it's not always immediately reflected in the jobless claims, what's actually happening in the jobless side of the business. That does play catch up over time. Because again, initially when people get laid off, most people, instead of just running right out to get a jobless claim, they'll start looking for another job. And then when they can't find one, then they go file their jobless claim. So it takes a little while. So those jobless claims numbers will start to pick up steam probably once we get into 2023, because that's about how long it'll take for that lag effect to play out.
Okay. All right. So seems like, you are seeing the same sort of negative trends still continuing there or accelerating on the consumer side.
Yeah. And by the way, real quick, before you stop off of that, while you're looking at jobless claims, that's okay, right? That's people that have been, terminated from a job. Okay. So if you quit or you leave your job, you can't file a jobless claims, right? So the only time you can file a jobless claims is when you've been fired.
Right.
So but these are initial jobless claims. So these are people that have lost their job and they've gone out and filed for the first time. And there's a bunch of, kind of estimates that go into that. And again, with all these surveys, it's kind of a sampling of data instead of just how many people actually filed, right?
Right.
So there's some fudgeability factor to that one. But what's important to watch and what tells you a lot more about the economy is continuing claims. Continuing claims have been rising fairly steadily. And, while initial jobless claims have actually come down a little bit over the last couple of weeks, and you'll see that kind of tailor off a little bit more as we go, kind of into the school year. Jobless claims tend to kind of drop a little bit, and then they'll pick up, at the beginning of the year again, because we have all the holiday seasonal hiring coming up.
Right.
But continuing claims tell you a lot more about the economy, because those are the 4-week averages of claims that are continuing to make claims. And those are rising pretty steadily. And these are people that are getting claims, but they can't find work. And so they keep making additional claims. So, that tells you, that as far as an indicator about the health of the economy, continuing claims actually tell you more about that than initial claims.
All right. And I haven't looked at continuing claims recently, but it sounds like you're saying they're not headed in a great direction either.
No, they've been ticking up.
Yeah. All right. So, and obviously, folks, the reasons why we look at employment so closely is because, one, that hits real people where it hurts the most, right? It's the incomes that they rely on to do everything, right? So we're trying to give you as far in advance warning of a potential sort of jobs recession, but also, the fewer people who are employed, the fewer people out there who can spend money to drive the economy, right? And it begins to create almost sort of a vicious cycle. As the economy slows, companies lay people off, then less people can spend less in the economy, so the economy slows further, right? And you unless there's a catalyst to break that, you can go into a pretty recessionary place. All right. So on the consumer side, we got new data this week, which was the retail sales, and they were flat, which you could say is okay. That's not good or bad, but as you have said oftentimes on this program, they're reported at a dollar value. Right. So flat in an a year of high inflation like we're in actually means down in terms of actual transactions. Right.
Right.
Yeah.
Volume down, dollar price the same.
Right.
Because you're just paying more for it.
Right.
And look, but before you jump off of, I'm keep you going back to the employment.
Go anywhere you want.
Well, no, because you made a good point about wages, and that's what people spend in the economy. And the one thing that, look, we've been talking about disinflation for a while, and that inflation is going to come down. It's a function of math. As we get into next year, when we have these bigger inflation numbers, that disinflationary pressure will be there. Now, that doesn't mean inflation is going away. It's just the way we calculate it, right?
It's just not growing as fast. Yep.
Exactly. And one of the big problems the Fed's going to have, and, it's interesting because they point to it. They say, well, employment's still strong, and that's true. Wages are inflationary, and you have had a very big increase in wages over the last half year. Those wages have grown very sharply as people were trying to hire people to come back to work after the shutdown. And mind you, again, we go back, talk about employment. While everybody's talking about strong employment, all we've done, and we just did this at the last report, all we've done is get back to where we were employment-wise in March of 2020.
Yeah.
Right. So we haven't created any new jobs. All we've done is hire everybody back we fired, and we're paying more for them now to come back to work. So that's very inflationary. So what that's going to wind up doing is potentially, and for all these bulls that are sitting there going, oh, we're about to have the Fed pivot, and that's great, and that means stocks are going to go up. That wage factor is going to keep inflationary pressures higher than expected. In other words, we're not going to get back to that 2% mark as fast as a lot of the bulls are expecting. And secondly, those high wages are going to eat into corporate profit margins. Yep. Because the problem with wages is that it's very hard to take money away from people. So I really kind of have two choices. I either lay Adam off, or I tell him I'm going to have to cut his salary. Those generally don't work well in either case. So companies are really reticent to go to people and start telling them they have to cut their salary. So the first thing that'll happen is that's going to start eating into profit margins. Corporate profit margins are still near record highs. Those have a long way to come down. And again, as we talked about earlier with earnings, that's not been priced into the market yet.
Right. One other and I'm not putting these words in your mouth, I'm putting them in Stephanie's mouth, but one other way in which the market is whistling past the graveyard, right? It's just not taking that margin compression into full account yet, it seems.
Right.
All right. So, the consumer credit numbers continue to worsen, right? We're back to our all-time record. We'd seen a lot of folks pay off a lot of their revolving, consumer debt, like their credit cards, with all the stimulus that they got in the wake of the pandemic. But that payoff is long gone, and that we're now back to all-time highs, and we're increasing on a monthly basis at record rates at this point. So it just says that people are financing a lot of, a tremendous amount of their lifestyles than they were before on plastic, and that has an expiration date at some point, right, where you hit the debt saturation level at the household level. And then last,
look, I think you're there, by the way.
You think we're there at the debt saturation level?
Yeah.
Well, we'll find out pretty soon.
Yeah, no, it won't take long. The payoff gave people room to put money back on their credit cards, but now you're back to all-time highs. It's now taking about $6,500 a year in additional credit just to make ends meet. So, there's just a limit to how much people can charge. So I think we're pretty close.
Yeah, well, that'll be interesting. But let's stop on this just for a second. So what happens then? So let's say the average American household just is like, all right, I can't take on any more debt. Either I can't service it if I do, or the lender won't give it to me because they're looking at my existing balances.
Right.
What happens to consumer spending there? 70% of GDP.
It stops. I mean, well, it slows down, obviously. So, what's going to happen is that people have to start making more. And we're seeing this now. If you took a look at those recent retail sales reports, the saving grace of that last retail sales report was the price of gas went down,
yeah,
which gave people more money to spend on other stuff. And so they were able to shift some of that money into other areas. Now, and that's all we're doing is we're playing a game of shuffle the dominoes, right? And
rob
so,
Peter to pay Paul.
Yeah. You're just moving. I didn't spend as much on gas this week, so now I can go do something smart and buy my wife some flowers. As soon as gas goes back up, I can't buy flowers anymore. So, again, we're not adjusting for what's happening in the economy. In reality, we're making all these assumptions that everything's just fine. But, if you take a look at a lot of these indicators that come out, debt to income ratios, disposable income to credit, these type of things, and they all show like, debt to income ratios for households is really low. I mean, there's just the household balance sheet is incredibly healthy. It's not. It's just for the top 10% of people that paid off all their debt during the shutdown, and now they got lots of disposable income. So the bottom 80%, they're tapped out, and we know those statistics. We talked about those statistics before, but they're tapped out. They don't have a lot of room to run, and the longer that inflation stays higher, the harder it is for them to make ends meet.
All right, so I'm going to go to the housing market in just a minute. My last stat on the consumer was just kind of a good news, bad news, which is the University of Michigan consumer sentiment actually jumped finally, more than was expected. It's still way down there at record lows, but it's not as much of a record low as it was, the last month. But still, net sentiment is still really pretty pessimistic on the consumer side of things. So Lance, let's just tug at this for a second with your macro hat on. If you think the consumer is close to hitting their debt saturation level, and that is going to slow consumer spending, which is the majority of GDP, and as you mentioned, labor is going to, and other input costs that have been rising with this inflation, are going to continue to crimp corporate profit margins. You sort of have a worse of both worlds scenario, right? You're getting the consumer budgets pinched and corporate budgets pinched. Tell me, if you can, a bullish argument for 2023, taking those two things into account.
Did you say my macro hat or my MAGA hat? I wasn't quite sure what you said.
So. Oh, I did say macro. I did say macro. But yeah, I mean, if you're looking at reduction in spending on both barrels of the shotgun, how does somebody say, yeah, but don't worry about that because X?
Well, this is the joke, right? So, in order to get the macro environment back into a position to where the bulls have control, you've got to make America great again. And what I mean by that is not from the political sense, but you've got to get the economy growing again, right? That's going to be the important thing. And so, from a macro perspective, you've got to shift this balance of data coming in, and it's got to bottom and begin to turn back up. And now, could that happen? That's the question: is what will it take in order for this economic data to start turning around? Well, there doesn't seem to be anything at the moment that is going to change that around. New orders, look, run through the manufacturing side of the business, right? New orders are declining, backlogs are declining, shipping times are coming down. So we're basically seeing everything that was driving those indexes to record levels. They're all starting to reverse, and they're not done. They're not completing that reversal yet. They will. And this is all, when this is the important thing is when we're looking out, it's the big risk is time frames. What's going to happen between now and the end of the year? As I said, we've got Labor Day, back to school, Halloween, Thanksgiving, we've got Christmas, then you've got Valentine's Day, New Year's, all coming up here. And that's all shopping, right? That's all spending by the consumer. Oh, can't forget my wife's birthday, right in the middle of all that. So, that's going to help move the economy by 0.1% just on her birthday present. So, that, and so those factors are going to feed into the economic data. So we're potentially going to see this economic data kind of start to flatten out a little bit. Now, it doesn't mean that it can't go back down next year, and it doesn't mean we can't have an ebb and kind of an S-shaped recovery, so to speak. Is that we have a little bit of a bounce, and then the recession sets in, and that's what I think is going to be the case. I think we're going to see a movement in the economy where we see strengthening in the economic data. And you and I will be having these conversations going, why is the economy getting stronger? This makes no sense. But it's just the ebb and flow of the economic cycle. But then next year, and I just wrote an article about this on the website at realinvestmentadvice.com, talking about no recession now, it'll be in 2023. So you'll have this recovery. It'll look like we had a soft landing in the economy, and then the recession hits second quarter, third quarter of next year, as all this tightening hits the economy and things slow down and begin to reverse.
Okay. So if I can recap real quickly, you're just saying, look, there's a lot of seasonal buying ahead of us. The consumer may be approaching their debt saturation level, but they still may have a little bit left in the tank on the card. They're going to spend as best they can at the end of this year. That may actually drive GDP higher than the negative reports that we've been getting the past couple quarters. Yep. And it may look like the soft landing is being engineered. I'd probably throw into that bullish argument another main bullish argument that I think has been out there, which is that, hey, Fed's getting on top of inflation, it looks like, and they're going to be able to pause or pivot sooner than the Fed at least thinks, right? And so they have this sort of magic option in there somewhere where the Fed, reverts maybe even back to easing at some point. I don't know. But anyways, we've got this sort of last gasp of consumer spending through the end of the year. As we go into next year, consumer household balance sheets probably going to be even in worse shape. The slowdown in the economy from the rate hikes may be putting us in a recession anyways, but then we start getting the delayed effect of all those, tightening to date that we talked about rolling in, which could make 2023 growth look pretty challenged. We'll put it that way nicely.
Well, again, and look, and when we're talking about economic growth, by the way, we're not talking about 5% economic growth here. We're talking about barely above zero.
Yeah.
Right? We're just talking about some positive number. Maybe it's 1% annualized growth or 1.5%. It's not going to be great. And remember, coming into this year, estimates for growth this year started out at the beginning of this year near 6%. We're going to be lucky to turn out 1% by the end of the year, maybe 1.5% by the end of the year. So, the economy, and I wrote an article about this back in, I think, May or June of 2020, right after we kind of did that first initial influx of money into the economy, and it was called Sugar Rush. And what the article discussed is that we're going to have this big sugar rush of economic activity because of all this liquidity in the economy. And just like when you give your kids a bunch of sugar when they're little, they run around like crazy for about 35 minutes, and then you find them curled up in a corner somewhere fast asleep. And that's kind of what's going to happen. And I wrote back then, I said, what's going to happen with the economy is you have this sugar crash that's going to come up in the economy. And that's what we're going through right now. And it's just that extraction of all that liquidity. Now, this is also an important point to the economic side of this discussion. what we're experiencing right now is the sugar crash from all that liquidity, and there's no more money coming in to, checks to households, et cetera. But now the economy is just returning back to what the normalcy of the economy should be. And that's probably somewhere around a 2% annualized growth rate. So again, it's just kind of things revert back to normal. You'll see the market kind of overshoot on the downside, and then it'll kind of come back up and start to kind of migrate back towards that 2% annualized growth rate, which isn't great, by the way. Pre-2000, 2% growth was called pre-recessionary, and now it's like we're just hoping to get 2% growth. So you could very well see this economy kind of trip back up towards that 2% level, and then the question will be that 2% level that the economy tries to settle at is then hit by all this tighter Fed monetary policy, and that's where the Fed realizes they made a mistake.
Right, and I think that this is what has people who watch this video scratching their heads about is okay, I can kind of understand that thesis. I don't see how that justifies the market going from here back up to new highs.
Yeah.
Right. I think that's a real head scratcher for folks right now. So any reaction to that?
Well, I don't see. Look, anything. Okay, first of all, let's just state that anything is possible. This market can do absolutely anything it wants to do, right? We've got, tremendous amount of money, still coming into the markets, passive indexers. So, this market can do a lot of things that just completely defy logic. Even, John Maynard Keynes way back in the 30s, the market can remain illogical longer than you can remain solvent, right? This is just the way markets can work. So could markets get to all-time highs? Sure. Absolutely possible. Probability wise, I don't see how it happens, but it could happen. Right. And I think, and what's important as investors is that we can't discount the possibilities. We need to invest on the probabilities. The probabilities suggest that we're not going to get to all-time highs, at least this year. And again, because there's a lot of challenges, inflation, economic growth, earnings, corporate profits, margins, all these types of things. Certainly lots of things that certain, the Fed, of course, doing their thing. So all those weigh against this idea that this market's going to rally back to all-time highs. But there's a possibility it could. Now, what could cause that? I don't know. And, but this is the same discussion that we were having, last year. Everybody was asking me, well, what caused this market to crash? It's like, I don't know. But what's going to happen is that something unexpected is going to crop up and it's going to completely derail the market. And it'll be some exogenous event that nobody's even paying attention to. And it's going to completely derail the markets. Turned out to be Russia. Right. So, the thing is, and this is why investing is A, so difficult, and B, it's not something, and again, when you look at your portfolio and how you structure your portfolio, if you want to be super bearish in your portfolio, that's fine, right? Have 80% of your money in a super bearish allocation, have 20% in a bullish allocation.
Yeah, you're taking this where I was going to take it, which is diversification is so important.
Yeah, and at least if you're completely wrong on your bearish thesis or bullish, you do it the other way, right? I'm a raging bull and I want all my money into Bed Bath & Beyond. Okay, put 80% of your money in Bed Bath & Beyond, put 20% in something that's totally non-correlated. Take a bearish stance against that. And the reason is that if at least you're wrong, you've got something that's offsetting some of that risk and it gives you time to unwind those other positions. Because, I've seen this, look, I've been doing this for 30 years and I've seen this market do stuff that nobody ever thought was possible. And unfortunately for many investors today, they've never been through a real bear market. There's a lot of investors in the markets today have never been through a bear market. There's tons of people writing commentary, doing videos and blogs and,
never seen.
Never have, they started in 2010. I love these young whippersnappers that they have on CNBC. It's like, you were in diapers during 2009 and now you're telling people how to invest money, but once you've been through a few of these things, you start to realize that markets have their own life to them. It's an organism, and we have to make sure and understand what is the market telling us and then navigate that as best we can. And again, this is why we rely, so much on short-term technicals, because that's what the market's telling us right now. That organism that is the body of buyers and sellers that are driving market prices in one direction or the other All technical analysis tells you is what they're thinking. That's it. It's not some magic wand. It's not right 100% of the time, but it gives you a good idea of the conversation that buyers and sellers are having. Are there more buyers than sellers? Yes or no? That's what you need to know. Longer term, the fundamentals matter. And so in the short term, though, we've got to manage our money to make money with an eye on that long-term horizon and making sure that we don't wind up totally on the wrong side of a crash when it occurs. And there's still that risk. We haven't had a crash. I've been making this argument for the last couple of months now that we've only had a correction here. We're not in a bear market. And there's a lot of factors that really kind of go behind that. Mm-hmm. But that doesn't mean we can't be in a bear market next year when the recession ultimately sets in.
Right. Well, and one of the reasons why I'm really digging into this, one was to surface the diversification point, but also I'm going to go through housing market data in just a second. And also, folks, we're going to go to, we're going to get to Lance's trades for the week too. So don't worry, I haven't forgotten about that. So much of the data that we talk about here looks pessimistic, and I want to reserve the right for the market to do whatever it's going to do. And so I want to try to understand the bullish case as best as I can, because as I said, I feel like it's kind of challenging to put it together, but that doesn't mean I want to dismiss it. So that's why I keep coming back to you to say, okay, so what argument could support something different, right? Yeah.
So look, there is only, if you look at the bullish arguments in the market, they're all technical. That's it. They're all technical. There are no fundamental bullish arguments in the media. If you take, it's like the number of stocks above, stocks have retraced 50% of the decline. Every time in history, that means, the bear market bottom was in. 90% of stocks above their 50-day moving average. Every time that's happened in the last 60 years, that means the bear market bottom was in. There's not one argument out there in the mainstream media that is a fundamentally based valuations are cheap. And when valuations have ever been this cheap, that's been the bottom of the bear market. The last time we had valuations that were cheap that signaled the bottom of the bear market was 1974, when we were at 7 times earnings, right? So, so every argument right now is simply technical, and that makes complete sense because this market has not relied on fundamentals for the past 12 years.
Right.
So, why are you trying to make a fundamental argument now when nobody's looked at fundamentals for 12 years? It's all a technical argument. Now, what we're going to need to have a fundamental basis for this is earnings improving, valuations at reasonable levels, trailing valuations, not forward valuations, margins starting to improve, those type of things. Now, when you start getting those fundamental factors in, economic data starting to improve. Now there's going to be your more fundamental support for a sustainable bull market. So again, what we're talking about here is a bull market rally, not a bull market, right? And those are two different things.
Got it. And for you specifically at RIA, I've been trying to ask you to wear the hat for all bulls right now in this conversation, but for RIA, I suppose that still makes you quite suspicious of the current rally. Meaning you may still play it as you feel you have to, but you're cautious.
Yeah, absolutely. And we're looking a lot right now at sector rotation models, and we just launched a whole new thing on our simpleadvisor.com website, which it looks at each sector of the market, and it breaks down the relative rotation between those sectors and the indexes and all the individual stocks within those sectors. And it gives you some really kind of good clues about what's overvalued and what's undervalued and where money's rotating to and from. And that's really the trick in the short term, is just trying to figure out where the cash, as Wayne Gretzky said, you skate to where the puck's going. And that's what relative rotation analysis tells you. It tells you where the puck is moving to. And, so that's really kind of the key focus that we've got in our shop right now, because again, we're sitting around scratching our head is going, look, I get the bullish technicals, but the Fed's hiking rates and tightening their balance sheet, the economy's slowing down, all the arguments we put out there, this makes no sense. And you go back and look at the 1960s and 70s, where the Fed was consistently fighting, rising interest rates and rising inflation. There were multiple issues. It's always interesting when you go back and look at the 60s and the 70s, everybody only remembers 1974, right? It's like, oh, I remember the 1974 bear market. That was the black bear. Barron's put out the article that said stocks are dead, and that was the bottom of the market. What people don't realize is that there were 3 bear markets prior to 1974. 74 was just the one that killed everybody. But there were 3 bear markets going into 1974 with recessions that were caused by the Fed hiking rates. The market would go into bear market. The Fed would lower interest rates. Inflation was still going up, so they start hiking rates again. They caused the next bear market and crash, and then they would lower rates. And that was the whole sequence through the 1960s and 70s. And finally, what broke that cycle was the 1974 bear market. 7 times valuations, 5% dividend yields. And finally, Paul Volcker broke the back of inflation and got inflation coming down. But it took basically 15 years and a negative 10% rate of real return for investors to get through that period.
All right. Which again, sort of maybe underscores the magical thinking of people saying, hey, the Fed is going to pivot soon because maybe it's actually going to, it'll achieve its accomplishment. It's like, hey guys, this took a decade and a half last time.
Yeah. We have an article on our website today talking on realinvestmentadvice.com. It's called This Isn't Paul Volcker's 1982. Tom Lee from Fundstrat, Uber Bull, right?
Uber Bull, who I've tried to head on this program, just FYI, folks. I have been extending invites to him.
Yeah, he'll never show up. But tell him I challenged him and maybe he'll show up. He doesn't know who I am, but you never know. But no, so he wrote this article called This Is Paul Volcker, this is like 1982. And he said in 1982, the Fed was hiking rates and you had a bear market, you had a 20% decline in the markets. And then the markets recovered the whole decline in 4 months. And then markets kept going on and we were into the bull market of the 80s and the 90s. And, the problem with kind of cherry picking a date and saying, okay, this is like 1982 is you kind of, and this is the point of the article, is you forgot everything that happened getting up to that point. Multiple bear markets, negative annualized rates of return over a 20-year period, one devastation after another. And then finally valuations getting crushed from 23 times earnings down to 7. That's what set the market up for that, realization that the long duration secular bull market was over. And finally things had gotten beaten up enough that, households and the financialization of the economy at that time through Ronald Reagan is what led to the beginning of that long secular bull market in the 80s and the 90s. But that's the difference is you got to be careful with when people throw out these analogies. Oh, this is like, this isn't Paul Volcker's 1982, right? And I guarantee you that Jerome Powell ain't Paul Volcker. So, this is not going to turn out the same as it was back then.
Right. And as I mentioned in previous videos we've done, that Volcker, kind of like you said, there's a long process before Volcker broke the back of inflation. And a big reason why he was able to is he was finally the guy that had the mandate to do it, right? Where inflation had been such a protracted problem that finally they said, look, your job is to do whatever it takes, right? So he had that air cover. I don't think Jerome Powell necessarily has a mandate to take interest rates up to, 18% if he had to, right? No. I mean, we're just not ready for that yet, right?
Yeah. Powell's got room for about 50 basis points more, and I think that's about all he's going to get.
Okay, yeah.
Oh, by the way, wait, before you jump, one last thing. I just want to say something about this economic data. Just remember one thing about all this economic data. We are 2 months from an election.
Right. And I'm assuming in there is some sort of inference that like it's getting as polished as possible right now to look as rosy as possible prior to the election.
And look, you see this all the time. We saw this, you see this in elections quite often where after the election, there's suddenly some fairly decent revisions, either positive or negative, to that data. So don't be surprised if by the time we get into December, that all of a sudden these employment numbers that we've been seeing magically get revised down pretty sharply. Pretty sharply,
yeah. That one, I'll actually take. I'll take that bet or whatever. I'll assume that that's happening because that one in particular really got stuck in my craw last week. All right, so just to try to make sure we get to your trades and bang through a few other remaining things. Housing market update real quick, just because we track that. We told folks that we would continue tracking that. We are now seeing the first, so San Francisco is now the major metro with the first year-over-year price decline. So, call it a canary in the coal mine or whatnot, but, San Francisco is one of the hottest housing markets in the country for the past decade. It's the most expensive right now still, but it's now seeing a year-over-year decline. All the other top hot metros are, most of them went up like 20% year over year a couple of months ago, but we're seeing that year-over-year comparison continue to dwindle in all those other markets as well. So it just shows that prices are beginning to stall in terms of growth. Some are actually softening. In San Francisco, they're seeing a big spike in inventory. So nationwide, the supply of homes for sale in the US grew at 31% year over year. That's a record rate. So that was last month. In the San Francisco Bay Area, that number is up 200% year over year, right? So you're really beginning to see some of the softening begin to kick in. Nationwide, you're seeing a spike in home buyers backing out of deals. So folks that bought new homes that were being constructed for them, now that the homes are getting ready, they're saying like, you know what? Mortgage rates have gone up. I'm not feeling as flush as I was. I think I'm going to try to back out of this deal if you let me. And then last thing on the housing market, Robert Shiller, founder of the Case-Shiller Index. I can't remember if I mentioned this last week. I don't think I did, but if I did, forgive me. He had a quote the other day that said, "Home prices haven't fallen since the 2007-2009 recession. Right now, things look almost as bad. Existing home sales are down, permits are down, a lot of signs that we'll see something. It may not be catastrophic, but it's time to consider that." So when a guy like Robert Shiller, who knows housing better than almost anybody, and he's not prone to hyperbole, begins to suggest the word potentially catastrophic and is comparing this market to what he saw back in 2007, we really better be paying attention.
Yeah, I can't argue with you.
Okay. So anyways, just reminding folks here that the situation for the housing market has been softening in a concerning way and continues to be in a trajectory that's got a lot of folks worried. For viewers too, I'm going to be doing an interview next week with Nick Jurley. So, housing expert. I've had him on a couple of times, but we're going to get Nick's latest forecasts just next week. All right. So let's get to the trades for the week. And then I've got one last sort of ranty topic for you, Lance.
All right. Now it's a really long list. We did a lot of work this week on the portfolio. So here we go. And that pretty much wraps it up.
Okay. All right. So you stayed status quo for the week.
So, what we had done previously, we had, added a little bit to tech exposure near the lows. The market rallied. We took some of that tech exposure back off again, just because markets were kind of getting ahead of themselves. Apple has just gone way, too far here. So we built a position in Apple and then took some of that back off again. We're still long these positions, by the way. We just added to them and then took them back, took some profits and took them back off.
Yep. Position sizing.
Yeah. And then, we talked about previously about the energy sector being too overbought. Well, they got oversold. And so we added to our positions in ExxonMobil and Devon. And those have been doing fairly well this week and have helped add a little bit of beta to the portfolio. So, and again, it's interesting. We were going through, so every Friday we go through our return analysis and, we look at each one of our different models. We run a whole variety of different models for different levels of conservative people, high net worth, family offices, those type of things. So, we go through the models and their benchmarks and how we're doing. And, and it's been very interesting. One of our big concerns, we had about a 700 basis point lead over our primary benchmark back in June and July at the bottoms. And I even talked about that here on the show with you. I said, my big concern here is because we're underweight equity, that if this market really rallies, that we're going to give up a whole bunch of that gain against our benchmark because we're so underweight equity. And what's been very interesting is we have given up some of that gain, but not nearly as much as I would have thought we had. We've still got about a 450 basis point lead over our benchmark right now. So we've given up some, but considering, we're half the weight of the index pretty much in terms of equity, I thought we would have given them a lot more. So, but part of that goes to the beta, the beta analysis of when we're buying securities, we have a little bit higher beta in some areas of our portfolio that have fortunately been doing well, tech, energy, those type of things. One of the things we're looking to add to, we almost did this week, and we'll probably do it next week, is looking to increase our weighting in healthcare. Healthcare starting to get some money flows. It's been really beaten up relative to the S&P 500. So looks like it. And there's some good, fundamentally strong companies in healthcare, in the healthcare sector. And look, we're all getting older and need more healthcare. So, kind of a long-term thesis. We love healthcare. We had reduced that weighting earlier this year, and we're kind of looking to start adding back to that now.
Okay, great. So that's actually a good segue into just a concept I wanted to toss out here was, a few days ago, I did a Twitter space, which basically is a audio conversation on Twitter. And I invited any Wealthion followers who wanted to come on there and just engage with me in a quick conversation about, any feedback they had about what we're doing, topics they'd like to see more of, guests they'd like to see more of, just ways in which we can better serve their interests. And one idea that was tossed out there was, you guys do a great job at Wealthion on macro. The request was, and I think this is probably from more of a sort of self-directed investor type, who said, I'd love to see some more micro, which is, he said, look, I invest for myself, I research companies, and then I decide whether I'm going to, buy them or not. But it's kind of a lonely process, and I'm not entirely sure if I'm doing it great. And I'd really love to sort of watch, a professional go through the process of valuing a company, right, to see how they look at it. What do they do with the financial statements? What are the key things that they look at when making their buys or not buy recommendations? And not only would I like to learn that process, but I'd love to see that type of person, go analyze a couple of stocks, and maybe even this could be an ongoing thing where you're analyzing a couple companies a week. You said you really like healthcare companies. I'm sure that type of person would be fascinating to see, okay, which of the companies did you consider? How do you analyze them? And then at the end, which ones did you decide to buy and which one did you decide to take a pass on? Is that something that you'd ever be interested in just sort of piloting on this program at some point, Lance? We'll do it once and see what folks think.
Yeah, sure. It'll be the most boring video on the planet, but yeah, we can certainly do it.
I don't know. I mean, you and Michael, you guys have your investment committee, Michael Ebowitz, who we interviewed on here not that long ago, and anyone else from your group. But this is something that you guys do pretty much weekly, right?
Yeah, no, it is. And it's a lot different than it used to be. Back in the day, when we were analyzing stocks, back pre-2000, you get a 10K, 10Q report, and you have to pile through it, and find all the data. And now it's all, all these services now have data services that have all that data.
It's so much easier to get the data. And as a junior investment banking analyst, that was my first job out of college. I was the monkey who stayed up till 4 a.m, pulling all of that data out of those paper 10Ks and Qs that you had to order from a courier service to get. I mean, it was a nightmare.
Yeah. Oh, it is. And, nowadays it's, for me and Mike and Nick and the others at my office is, it's a lot of spreadsheet work and, a lot of automated models and automated analysis that we do. And and actually what we're doing is one of the things we're doing with Simplevisor.com is we're taking all our analytical work that we do in-house and uploading it to Simplevisor.com. So people that want to analyze stocks the way we do it, they can get access to all the same tools that we have there. So we can certainly kind of go through that and show you some different, some of the different things we look at and kind of some of the different measures we look for.
All right. Well, why don't we do this, folks? If there is enough interest, if you are watching this, would like to see that, let us know in the comments section below. If there's enough interest, sounds like Lance is kind enough to be game to try this once. We'll do it. We'll pick a Saturday. We'll do this for a Saturday at some point in the future and see what everybody thinks. And if they like more of it, maybe we make it a recurring segment. Maybe we eventually spin it off as something bigger. Who knows? But again, if you love the idea or hate the idea, let us know in the comments section below. One of the elements of this, bear market that we've been in, and I know you said we're not technically in a bear market right now, has, even before the market bounced, there were a lot of gray-haired investors, several of which who had on this program, and I would include you in that mix, who had said, hey, if this is a bear market, we're not at the end of it, because at the end of a bear market, nobody wants to touch a stock again, right? They're done with it, right? All the risk-seeking appetite is just bled out. But clearly, there's a lot of speculation still in the markets today, and a great example of that is what just happened this week with the Bed Bath & Beyond stock. So very quickly, for folks that didn't see what happened, Bed Bath and Beyond, the traditional retailer, I'm sure everybody knows who they are, had a GameStop moment where it got inducted into the Hall of Fame of the meme stocks, and largely because what's his name, Ryan Cohen, who's the CEO of GameStop, took a position in Bed Bath and Beyond, and the Wall Street Bets apes army rushed on in, and the stock went from $4 to $28 over just like 2 weeks, right? And that was all because of a gamma squeeze. Can you just quickly describe what a gamma squeeze is for folks, Lance?
So a gamma, the easiest way to think about it is we talk about short squeezes all the time.
Yeah.
And it's pretty much the same thing, which is where you start getting a price movement in the stock in one direction, and then everybody starts piling into options, which then forces that price to go up. Because remember, when there's somebody buying, if somebody buys, let me back this up. If you want to buy an option on something, right? So you've got to get a contract for that option to buy it, which means that I have to be writing the option on the other side to sell to you. So there's two parties to writing an option. And so once these things start moving, it creates this basically a squeeze in the option structures, and causes these abnormally large price movements, which is, what we saw happen. It's interesting because Ryan Cohen's like, yeah, I took this position. It's, I'm long-term on, Bed Bath and Beyond. I'm all behind it. And then, as soon as he makes a killing on it, he's like, man, I'm out.
Yeah, he did. It was, so the whole point here, right, is that this was, it was a classic rug pull moment for all the retail investors that jumped on this bandwagon and jumped in. So all that whole Reddit, crowd, all those apes, they got left holding the bag. Their kind of hero, Ryan Cohen, said, I'm in this thing. They jumped in with him. And then he said, oh, actually, I just sold, right? And then the price cratered. So the price, I don't even know where it is right now, but it was down 40% today when I looked at it. And that was after having been down a lot before. So it's back getting down. I don't know if it's at $4, but it's definitely nearing that territory right now. So these people that jumped in just a couple of days ago are sitting on these horrific losses. And what I don't like about this, and by the way, this isn't my rant yet. What I don't like about this is this approach of trying to manufacture a gamma squeeze. It's kind of like a back alley beating for these companies. It's not investing. It's, investor groups that have the capital, the muscle, whatever, the brand. They can come in and they can engineer this sort of very short-lived, very intense, and very absolutely not fundamentals-based squeeze that basically suckers money in that they then pocket and then leave with, right? So it's not good for the companies. It's not good for the majority investors. It's really, again, it's sort of like I just look at it as kind of like, some sort of street gang that just sees a guy who's, shuffling down the street, and they just push him in an alley and beat him up and, take what he has. I feel like this is the investing version of that.
Well, look, and this is all due to the Fed. The Fed created this. The government created this with all these checks, and when you give people capital and you show them that there is a way to multiply capital very quickly without having to work for it, you create a gambling environment, which is exactly what's happened. And, the rise of Wall Street bets we saw that back in 2020, 2021. And, what nobody ever looks at is like, all these Wall Street Reddit traders were out there running up these stocks. Well, Wall Street was more than happy with that. They were issuing out IPOs of crappy companies left and right. And if they couldn't get into an IPO, they did SPACs, right? A SPAC is a backdoor IPO when a company isn't strong enough to qualify for an IPO, right? So, but Wall Street, look, and this is the thing that people have to remember, everybody looks at Wall Street like it's their friend or something. I was talking about this on the radio show the other day, and I said, I remember back in the day, there used to be these commercials with like UBS and Morgan Stanley, and UBS's was always great because their motto was, it's you and us. And they would show like a couple sitting on the beach, in their retirement years. Yeah. And it's not you and us. It is, you are the cannon fodder for us, and we're going to sell you product. And that's what Wall Street does. They sell you product. So if you come out and start wanting, to throw money at stupid things, they're going to give you stupid things to throw money at. And when you lose your money, that's your fault, not theirs.
So this is my main rant. So look, it's one thing when you have a big player who can, exercise their unfair clout, and that's sort of a Ryan Cohen here, the CEO of GameStop, that started this thing. And that's bad, and I don't think we should have it. But on a much wider scale, your point there about if they can make money selling stupid crap to people, they're going to. Let me tell you a personal story that's going to make my larger point. So the other day, a few weeks back, maybe a couple of months back, my younger daughter, 15 years old, came to me and said, "Hey, I think I'm actually, ready to start learning about investing, Dad. Can you help me?" And I said, "Yeah." And so we looked around, and I ended up creating a trading account for her on Robinhood. For two reasons. One, I was kind of curious just to sort of see what all the hullabaloo about it was about, but also, their mobile first design, it's by far like the most intuitive for 15-year-olds. Like all teenagers and young, 20-year-olds that are trading are generally using Robinhood because it's basically been created for them in mind. It's very easy for them to use. So signed up the account for her. We put in like $150. I mean, not very much. She's bought a couple fractional shares of like one or two, pretty steady Eddie type companies. But because I had to open the account for her, because she's not technically an adult, I get all the marketing emails from Robinhood. And I just posted on Twitter the other day one that they sent me, which is, "Hey, you probably don't realize how easy it is to start trading options. We can get you going in just a single click. Click here right now to begin your career as a successful options trader." And look, yeah, they don't know my daughter's 15 necessarily, but they do know that most of their account holders are very much on the younger end of the spectrum. And they also know that this is a relatively new account with $150 freaking dollars in it, right? But the fact that they're pushing options on this type of person is just mind-boggling. I mean, Lance, you've been in this business a lot longer than I have. I mean, even 10, even 5 years ago, options were still looked at as a pretty rarefied instrument for the average investor to be investing in. And it was very much, don't go there unless you've really practiced and really have a lot of experience. But now it's like, they're just pushing it like literally like a drug dealer pushing drugs on folks. So I'd love to let me get your reaction to that, and then we'll wrap about kind of what's the benefit, and I don't think there is one, of creating a generation of speculators versus investors.
Well, so first of all, we have continued really ever since 1998. Stocks used to be priced in fraction, in eighths, quarters, halves, right?
Right.
So if you wanted to buy a stock, you bought a stock at 50 and an eighth or 50 and a quarter or 50 and a half, whatever it was. And, that allowed for commissions to be paid to the market makers. And, it worked pretty well. But that wasn't good enough. Everybody said, "Oh, that's not fair. There's too big of a spread between the buys and the sells, and we need to bring that down. So we need to do decimalization." So then we moved into pennies, right? So now the spread's 50.01 and 50.02, right? So, and then we said, well, commissions aren't fair. We need to pay, we need to have flat fee and free trading. And so we've created that. And each one of these things that we do, they sound harmless on the surface. And I wrote some articles about this on the website talking about free trading isn't really free. And, because you pay for it in different ways. And for instance, with Robinhood, they're commingling all these orders and selling them off to Citadel, and they get paid for order flow.
Right, they pay for order flow.
And pay for order flow has been under a lot of scrutiny by the SEC now because it's not fair.
Right.
It's market manipulation, and you wind up paying a lot more for your trades.
Right. The scrutiny is very well deserved.
Yeah. And so, free isn't free. So, the best thing that we could do for individuals is move back to a point in time to where you paid a commission for a trade. And while that sounds horrible, it's like, oh my gosh, now you're gonna, now I've got to pay $10 for a trade or whatever. Yeah, it's okay. Because what it did was it slowed down the speculative trading. People held their shares longer. They allowed for the fundamental value of these companies to mature to justify paying that $10 commission. And it wound up giving people better returns on their money over time. And it reduced that speculation that goes on in the markets that we see today, where people are just hammering themselves and losing all their capital. The only winners in this game ultimately isn't going to be the traders. It's not going to be the retail investors. It's not going to be your daughter. It's going to be Robinhood and Wall Street, because they're going to wind up taking all their money at some point.
Well, exactly. I mean, the whole part of this is it just feels incredibly predatory, right? It's like you're pushing an instrument that this person has absolutely no business, as far as you can tell, dealing with, and yet you're there's a reason why we've seen naked call option buying on all these meme stocks explode over the past couple of years, is because they've gamified it, and they've built this culture around focusing on the few people who actually made out pretty well, ignoring all the people that are getting destroyed through it. So to your point, it's go ahead.
Yeah, no, I was just going to say, look, I have people email me all the time. It's like, I've got my son, he's 10, 15, 12, whatever. I want to set up an account for him. What should I do? I go, open up a 529 plan. Best thing you can do for them. Put money away for their college, get them through college. The best thing you can do to teach somebody how to trade, and if I walked you into a garage and there were a million parts of a car on the floor, I said, hey, tell you what, there's a free car right there. I got to just put it together. And you'd never seen a car before, good luck, right? Odds are you're going to wind up with something, but it's not going to be a car. Consequently, if I walk you into a garage and say, here's a car, let's take it, let's go drive it. Let's learn how to drive it. Let's see how it all works. And then let's take it apart and see how it was built. And then we can start fixing it up, right? We can make it a hot rod, whatever we're going to do with it. You're much more likely to be successful in that environment. I mean, there's never a guy that's really good with cars that grew up saying, oh yeah, I started with a nut and a bolt and I built a car. That's not the way it happened. And so the point is, if you want to teach somebody to invest right, open up an account, buy an S&P 500 index, SPY, a mutual fund, it doesn't matter. And watch how it trades over the course of a year. So when it goes up in price, see why it's going up in price. What's happening in the economy, what's happening in the markets, what's driving that price of the index higher or lower. Understand how the car operates. Then once you understand what drives the market, because when markets are rising, 80% of stocks are going to go up with the market roughly. And when it falls, 80% are going to fall, right? So once I can understand the overall dynamic of how the market works, now we can go back and start looking at the parts and say, okay, let's talk about the parts of the market where I want to invest. But people try to do it entirely backwards by going, oh, I'm going to go buy Best Buy and GameStop and AMC because I saw on Reddit that they're going up in price. Right. And that's just gambling. That's just speculation. That always turns out bad eventually. And eventually they wind up losing all their money. And look, here's the bottom line. If this investing thing worked anywhere at all, like the media tells you, you explain to me how after three major bull markets, 1980 to 2000, 2002 to 2008, and 2009 through now, how is it that 80% of Americans have less than $500 in the bank and less than 1 year's salary saved up for retirement?
Right.
Explain that to me.
Right. Well, okay. So first off, I love that analogy about the car and also the advice about buying the S&P fund. And that'll actually be my next conversation with my daughter on this. And, at a high level, the concern I have is it's less for my daughter because I'm getting those emails. She isn't. She has me as a mentor through this process, right? But I think of the vast majority of people in the younger generations who don't, right? And they're just getting bombarded by all of this marketing, right? And so, younger generations have been disincented to save, right? And I lay a lot of the fault and what I'm about to list here at the feet of the Fed, like you do, right? The Fed dropped interest rates to rock bottom levels. So, they're not getting anything except negative real returns in their bank savings account, right? So these guys have stopped saving, right? There's no incentive for them. Second, they're not investing anymore because they look at how unaffordable, the middle class lifestyle is, and they're concluding, God, the only way that I'm going to be able to get in there is if I hit some home run, right? And to do that, I'm going to have to really reach for yield. And so I'm going to go look at these things that I see in the media, other people are making crazy returns on. I'm going to buy Dogecoin. I'm going to buy meme stocks. You've got your finger up. Go ahead.
I'm going to disagree with you right there.
Okay.
Because it's not that. They're not disincentivized by not being able to afford things. They're disincentivized by social media that they want it now, right? They see all these people on social media with these fake profiles of private jets and Lear jets and all this type of stuff. And what they're missing is, and I have this conversation with my kids repeatedly, and I get a lot of pushback from them. It's like, well, we're not you, Dad, and your expectations are too high for us. And I'm like, no, they're not. You've got to put in the work. You don't start an entry-level life living a middle-class life. You're going to start an entry-level life at an entry-level life, and you're going to have to rent an apartment. You're going to have to buy a car that you really probably don't like, and it's not going to be fancy. And you're going to be eating a lot of top ramen and macaroni and cheese out of craft bags for a while, but you're going to start saving some money. And then once you start saving some money, you work your way up in your job, you put in the time, you put in the effort, you save up money, then you begin to invest, then you begin to save more money, you manage your cash flow, you do all the things right, then you get the middle-class lifestyle. Then you start investing into your own business opportunities, you piggyback on the back of capitalism, then you move into the upper-class lifestyle. It doesn't happen overnight, unless you're that kid that just invested 27 million into Bed Bath & Beyond and made $100 million.
Right, made 110 million overnight.
That's a different story. But for the average person, I do blame it on the Fed. I agree with you, right? The Fed has made saving a bad word. If I could put money at 5% in a savings account, I'd tell my kids, just you're saving 5% a year. 5% a year, you just save money. You're good.
Right.
We've destroyed that. But social media is destroying the very fabric of their understanding of what life is supposed to be like.
So I'm going to agree 100% with you. I'm going to add an and. So totally agree with the corrosive and toxic effects that social media culture has had on kids' expectations about what they should want in life, right? And I think any parent of a Millennial or Gen Z probably knows exactly what I'm talking about here. But I do think, though, that it is harder, and I'm not trying to give them a free pass. And look, I have the exact same conversation that you just had with your kids. On a relative basis, housing costs a lot more than it used to. Wages have not caught up. Education costs a lot more than it used to. Cars cost a lot more than it used to. These are all on a relative basis. And even in the car thing, to go back to your garage analogy, when you were a teenager a generation ago, you could buy a car and you could kind of learn to fix it up on your own, and you could buy a beater and keep it on the road. You can't do that today because cars are so computerized now that you just can't get the components, right? So anyways, long story short.
Fair point.
Yeah. So all I'm saying is it's kids are not investors. They haven't developed an investing mindset, right? The younger generation of investors, younger millennials and the Gen Zs, they have developed this swing for the fences, speculative mindset. So they don't even know how to do the kind of micro, company analysis we were just talking about a few minutes ago, right? All they know is okay, so what's hot right now, and what's the buzz on Wall Street bets, and okay, what's the next hot crypto? Okay, that's what I'm going to put my money in, right? It's all speculation. So the big concern I have is that, just like what happened right now in Bed Bath & Beyond, right, where it's all the retail speculators who just got blown up by that, right, is time will prove out that speculation is not a good way to build long-term sustainable wealth. And these younger generations could basically give up on the markets, right? So folks like you and I might say, if we got a little too hot and frothy making some speculative bets, we'd say, okay, that doesn't work. Let's go back to the old school way of investing. These kids don't know the old school way of investing. So the analogy I like to use is, a cat that jumps on a hot stove and gets burned isn't going to jump on a hot stove again, but he's not going to jump on a cold stove over. He's just going to be done with stoves. So you could have these generations that if we go into another bear market and they just lose it all again because they've been in all these speculative bets, they might just give up on the capital markets for good going forward. And that's not a societal good either.
No, they will. Look, it happened after 1929. My grandmother, when she passed away, we found jars of cash literally hidden in her house. Because after 1929, she was born in 1911. After 1929, and what happened through the 30s and the 40s, she didn't trust anybody with cash.
It's a long-lasting emotional trauma, right?
After 1974, interesting statistics. After the bear market of 1974, when Barron said stocks are dead, they truly were. In 1990. That was when investors actually started coming back into the market, retail investors. In 1995, about 80% of all the investors in the markets in 1995 had started in 1990. By 2000, about 80% of all the investors in the markets had all started in 1995. And so the point is that after each one of these major traumas, same thing occurred after 2003. Those investors didn't come back. A lot of those investors didn't come back. And the ones that didn't come back until very late. Same thing after the 2009 financial crisis. There's a lot of people that just never came back to the financial markets after they lost everything in housing and the markets and their 401k plan and Enron and all that, right? So each one of these major bear markets have wiped out a generation of investors. And again, this is why when you go back and look at those statistics, why is it that, after three major bull markets, why do 80% of people barely have any money in the bank? Because they're not investing in the markets. They're, and we make it sound like this is great, get rich, quick thing. And it's not. Markets will help you preserve your wealth over time and help you, adjust your savings for inflation. That's what the markets are supposed to do. That's all they're supposed to do. You should invest to your investment return goals should be the rate of inflation, not some random benchmark.
Right.
Because it's simply a function of growing your savings. You have the same purchasing power parity in the future. But we've screwed that up repeatedly through the markets. And now with the Fed and what's been going on really since 2000 with the Fed, adjustable rate mortgages with Alan Greenspan and all that nonsense, we've just financialized this market into a big giant casino that only benefits the wealthy and just keeps acting as a wealth transfer mechanism from the middle class to the rich.
All right. Well, look, I could keep ranting with you on this forever, but I think this is going to be our longest market recap yet, Lance. So I'm going to have to wrap it up.
Yeah, my wife is telling me to hurry up.
She's giving you the cut. Okay, good. The top takeaway that I sort of have from this rant is, look, as members of the older generation who remember true investing and hopefully still practice it, it's our job to try to help these younger generations learn true investing for as much as we can get them to listen to, and maybe they won't listen until they get burned, but hopefully if that's the case, we're there then to help them pick back up, recover, and start afresh with a saner approach than today's current speculative frenzy. All right, so in wrapping up here real quick, Lance and I have been talking for months that we're going to do a retirement planning webinar for you folks with the personal finance experts that are on his staff. We told you last week that that's going to be coming up this next Saturday. So instead of doing one of these regular weekly market recaps, instead we're going to have that webinar. We've had a ton amount of interest in that. Folks, you just really need to just come to this YouTube channel same time next week. But if you're really itching, you can put in your browser wealthion.com/retirement planning, and it'll send you to that video. In fact, it'll send you there right now. You'll just see a countdown timer that says this event's going to start in 7 days or whenever you go there. But we'll be doing that next week at this regular time. A reminder that Wealthion's upcoming conference, our annual fall conference, is coming up next month. It's all online. Just a killer faculty for that. Lance will be there throughout the day, and at the end of the day, he and the guys at New Harbor will be answering any questions that folks want to ask. I won't go through the whole list again, but Lacey Hunt, Lynn Alden, Grant Williams, Stephanie Pomboy, a whole bunch of other great speakers. To learn more about that, as well as to register and get the almost 30% off early bird discount, just go to wealthion.com/conference. And it's all there. Last, if you continue to enjoy seeing Lance and me go back and forth like this for as long as we did today, and really want to see more of these continued market recaps, please do us a favor. Just support this channel by hitting the like button and then clicking on the red subscribe button below, as well as that little bell icon right next to it. Lance, thanks so much for joining us again for another week. All right, he's waiting, folks. All right, and everybody else, thanks so much for watching. See you next week.